Hello everybody, welcome back to another valuation investing video. And today in this video, I'm be going over UnitedHealth Stock once again because with this recent news that has just come out, I think this could change UnitedHealth Stock forever, and the trajectory of this stock has become extremely bullish to me. So with that being said, let's get into UnitedHealth Stock. As we can see here with UnitedHealth Stock, we can see over the past year, it's still down 47%. So it's still having a very bad year, but yet looking at the past month, it is up only 8%, but since it's low, it's up 28% as a result of some recent super investors purchasing into this company. Going over to the super investor buys, we can see here we have a lot of buys here compared to the sells, and obviously there's some more notable ones. Like most of you have probably known, I did make a video on this. We have Warren Buffett bought into UnitedHealth, as we can see, 5 million shares, even though it's only 0.6% of his portfolio. That's a pretty big buy for Warren Buffett. Also, we have another super investor, Michael Burry, that's well known from The Big Short. He did buy some call options for UnitedHealth, so he has extra leverage. But seeing this, look at how much that has changed his portfolio. It's 11% of his portfolio now. And as we can see here, we have 5 super investors that newly bought UnitedHealth. We do have 3 that did sell out, but overall more buys than sells, so this looks good for UnitedHealth in the recent quarter. A lot of super investors seem to like this company. But getting into why UnitedHealth is down so much over the past year, down nearly 50% over the past year, the main reasons is because of the higher medical costs for this company. The company has been dealing with a spike in healthcare costs, especially with its Medicare Advantage business. This has squeezed profit margins as the cost of providing care have been higher than the company anticipated when setting its premiums. So it was kind of a missed timing for basically all of these health insurance companies, where they anticipated less costs, but this has really hurt all these companies, which is why you see every health insurance company down nearly 50% this year because of such high medical costs. That's the reason for why all these companies are down so much. Also, reduced profit outlook, which makes sense because of the decrease in profit margin, which they've reduced this twice and has been almost 50% reduction for the year. Also, regulatory scrutiny and investigations for UnitedHealth have some people worried because the company is facing increasing pressure and scrutiny from the government regulators. The Department of Justice is reportedly investigating UnitedHealth's group business practices, particularly how it records diagnoses for its Medicare Advantage plans, which can lead to higher payments. So with UnitedHealth, essentially what the DOJ is investigating is, say a patient comes in and says they have this illness, they're investigating to see if UnitedHealth has over-exaggerated that illness in order to get more money. So if it does find out that in evidence that this is true, then this will be terrible for the company. But there's not any evidence so far saying that this has happened, so that's not too bad, too much of a worry right now. Also, taking a look at the leadership changes, we can see the company has also faced a bunch of leaders in the CEO position, where, as we know, recently their CEO did get assassinated, and since then they've had multiple newer CEOs. They've had some resign and come back. They've had new ones. They've had a bunch of leadership changes. So this could potentially affect the company, but I think the main reason is obviously the higher medical costs and then the regulatory scrutiny and investigations. I think that's the main reason for why this company's down so much. And for this reason, I'm going to take a look at the UnitedHealth moat. So when looking at a moat, this is what Warren Buffett likes to look at. And essentially a moat is how much competitive advantage do they have over others, in which we want a bigger moat for UnitedHealth, like a castle. How if there's a bigger moat, it's going to be harder to get in the castle. Very similar to stocks or companies, if you have a bigger moat, it's very unlikely for other companies to disrupt UnitedHealth. And first, taking a look at their vertical integration, this has helped UnitedHealth. This is arguably their biggest moat, where UnitedHealth, the traditional health insurance arm that collects premiums, is UnitedHealthcare. Also, they have Optum, the health service and technology arm of their business. The synergy between these two segments is the core of the moat. When a patient has UnitedHealthcare insurance plan, their care may be delivered by an Optum Health clinic clinic. So their prescriptions managed by Optum Rx and the data from their visits analyze the Optum insights. So with the vertical integration, all you really need to do is go to United Healthcare or use any of their products. So you don't need to see any other companies. Also, economies of scale, they are the biggest health insurance company. And finally, high switching costs. So this is the main thing with most companies, their moat. High switching costs means that if you wanted to switch from United Healthcare to another insurance, it's going to actually cost you more, and it's going to be so much of a hassle that it's not even worth it. So when you're with a company and you're paying them, it's very hard to get out of that, and it's much worth it just to stay with them, even if it is a little bit more expensive. And going into the company's guidance with United Healthcare, we can see in their recent earnings, they did report revenues of nearly $112 billion, 13% increase year over year. So they actually increased that very good. Also, the adjusted earnings per share was $4.08. So that was a pretty big fall, where just a few quarters ago it was at $8. So this was a 50% decrease nearly. The company faces $6.5 billion more in medical costs than initially anticipated, so that's not good. But UnitedHealth has revised its 2025 adjusted earnings outlook to at least $16 per share and expects full year revenue to approach $448 billion, reflecting an 11% growth over 2024. So with that being said, I do believe that this company, the only real problem with UnitedHealth I see is basically just the high medical costs, but this is basically what's happening with every health insurance company. So while this is a very big issue, obviously, as long as they don't get to the negative profits, I think they're completely fine. Compared to some other health insurance companies, UnitedHealth is clearly the winner in how they're handling this. And the reason I'm saying this is because look at Centene. They're actually negative profit. The only other company I think is doing better could be Elevance Health, but all these other companies are near negative profit for this year. So that being said, UnitedHealth is doing good so far. Now going into Optum, like I mentioned earlier with United Healthcare, obviously you have the United Health insurance company where they offer health insurance, but they actually have another company under their belt, Optum, where they own Optum Health, Optum Insight, and Optum Rx. So Optum Health is the division delivers direct patient care and health management services. It includes clinics, urgent care centers, and physician groups. So that is the main healthcare side of the business, but looking at the Optum Insight of Optum in United Healthcare, this part of the company provides data, analytics, and technology services to a variety of clients in the healthcare industry. So that's more of a technology service by United Healthcare. And also Optum Rx as one of the largest pharmacy benefit managers in the United States, which manage prescription drugs for their employers, government programs, and health plans. So this company is very diversified compared to others. So I like that about this company. And taking a look here for Optum, we can see Optum Health is expected to have a full year operating earnings margin estimated at 3% to 3.1%. But the biggest problem here is a decline of 4% over 2024 in their full year 2025 revenue. So it has declined 4% with the revenue from 2024 to 2025. So it's decreasing, and obviously that's not good for a company. We want to see them increasing. While the Optum Insight revenues are expected to range from $19 billion to $19.5 billion compared to $18.8 billion in 2024, the full year operating margin is estimated at about 19%. So Optum Insight seems like it's doing good, and especially compared to Optum Health. And then Optum Rx is expected to be $151 billion to $151.5 billion compared to $133.2 billion a year, with the increase driven by continued strong growth in customers. So this is the main growth, I think, in this company, Optum Rx, which, like we said, going back here, Optum Rx is the pharmacy benefit manager. So this is where most of the growth is coming from United Health. So I think that looks pretty decent for United Health. Now going to my 7-step stock analysis, right here we can see right now United Health's at about a 10-ish PE ratio, so that is a check mark, so it looks good for United Health, and this is a very low valuation compared to the stock market of 25, and in the past this company ranged from 15 to a 25 PE ratio, so it's trading at a very low valuation compared to its past. That doesn't mean we should be buying today, but it does show us that it could be a good time to buy. So also the forward P ratio at 11 is very low, but I would like to say that the forward P ratio is higher than the trailing P ratio, which is kind of a red flag, because when the forward P ratio is higher, that means their earnings per share is expected to decrease, but we already know that's going to happen because of the increase in medical costs. Also, the revenue growth at 11%, that's very good, but the EPS growth is only growing at 1%, so that is a red X mark. But taking a look here at the income, we can see the revenue just continues to increase over time, and the net income with the light blue here, we can see that this has really started to decrease in the past year. Went from 22 billion to 14.4 billion. Taking a look at the quarterly here, we can see it has been dropping over the past quarter, which makes sense, but obviously we don't like to see that, but it is what is expected to happen, so it's not too bad. Now taking a look at the shares outstanding, we can see they're buying back at about 1%, so this is pretty good. This company is really good at buybacks and has been buying back at a pretty decent rate. That 1% is slightly rounded up. They've been buying back at about 0.8%, but I would like to add, with this recent quarter, they bought back nearly 2% year over year, so they have really increased that buybacks because of that huge drop in stock price, so that is looking good for UnitedHealth. I like buybacks because if you didn't know, if a company buys back shares, that means you'll actually own a greater percentage of the company. So I really like that about UnitedHealth. And then looking at the debt to equity, that's a little bit high to me. It's not too bad compared to some health insurance companies. This is the normal range, I'd say. The normal range for what I've seen is 60 to 80% debt to equity ratio. So it's nothing to be too worried about, but I normally like to see it less than 50%. Now finally, expected EPS growth rate for the next 5 years is 18%. So this number is a little bit over exaggerated, I would like to say, because the only reason I think this is over exaggerated, taking a look over here, we can see it's expecting from this past year where the earnings per share is super low. So they're expecting huge growth as a result of that, and they're expecting it to get back to where it was previously. So that's the only reason why it's supposed to be 18%, but nonetheless, the revenue only expected 5%. I think that's actually wrong. I don't think 5% is going to be the revenue growth rate for UnitedHealth. I think a fair revenue growth rate for UnitedHealth would probably be like 7 to 8% on the conservative side. So with that being said, the earnings per share is expected to grow a lot, but once again, it's a little bit over exaggeration since the EPS has dropped dramatically in the past year. It's just expected to increase a lot because analysts do expect them to get back to normal. So with that being said, taking a look at my intrinsic value calculator, in order to get a fair value price for UnitedHealth, I have to use this intrinsic value calculator that I've created on my own to get a fair value and to see what I think we can make at these prices today if we bought the stock today. So first, I have to put annual revenue growth assumptions. So what I think for the bear case, analysts expect this company to grow at 5% for each year. I think that's insanely low, but for the bear case, I will put 5%. Now for the base case, I think what's really going to happen would be anywhere from 8 to 10%, but I want to be slightly conservative here in case they don't fully get there. Now for the bull case, I think they could grow 11% in the future. I think that's still definitely achievable by UnitedHealth. As we saw just last quarter, they grew almost 13% year over year, but I do expect a little bit slowdown in that revenue growth rate. Now taking a look at the future profit margin for UnitedHealth, going over to here, we can see the profit margin of UnitedHealth. We can see it was increasing pretty well until this recent earnings. Right now, we get data of 5% profit margin, but in reality, right now, the profit margin was at 3%. So it's actually at an all-time low for UnitedHealth. But do I think it's going to be at 3% in the future? Probably not. But for the bear case, let's say it does remain at 3%. Even though I highly doubt it's going to stay at 3%, that is very unlikely to me. Now, for the base case, on average, they've been anywhere from 4 to 6%. I'm going to put 4.5%. Then for the bull case, let's put 6% profit margin. Now for the future PE ratio. Right now, they're trading at about a 10 to 12 PE ratio. In the past, they've been at anywhere from 15 to 25. So I think with a company growing at 5% revenue growth, pretty low profit margin, they do have a pretty decent moat, I believe. But for a future PE ratio like this, I think a fair PE ratio would be 12. Now for the base case, I think growing at 8% and a pretty decent moat, like I said, I think they could deserve a 16 PE ratio, and for the bull case, say they get a 20 PE ratio. Now for the shares outstanding. I think this company's been buying back at nearly 1%, and they just recently bought back at 2%. But do I think that's going to continue? Probably not. But I do think that they're going to buy back at about 0.5% on the bear side. For the base case, I think they'll buy back at 1%. For the bull case, I think they'll buy back at 1.5%. And with that being said, at today's price with some pretty conservative numbers, I believe, I think you can make about 10% on the base case, -7% on the bearish case, but it does make sense. It's the bearish case. For the bullish case, I think you can make almost 26%. So I think right now, honestly, would I say you should be buying this company? I'd say probably not, but I do believe that this company could be interesting if it got to what it was at just about a week ago. Like I said, I would be interested in this company under 250. Unfortunately, I did not buy this company. I just didn't feel like I should be buying this company. I didn't have a whole lot of cash to be purchasing, so I just stuck to my holdings I have right now. So with that being said, I think right now you can make about market average or maybe a little bit outperformance on the base case. Bull case, if you think they can grow at 11%, which I don't think it's out of the question, and with a 6% profit margin, I honestly don't think that this is out of the question for UnitedHealth. I think a very fair valuation, if we did 10% revenue growth and a 5% profit margin, you can make almost 15%. So honestly, I think this company could still be a decent buy today, but do your own research into this company. Me personally, I haven't bought any, but honestly, I might buy some in the future if it does get back under 250, but honestly, I don't think that's going to happen, and I think that the stock trajectory will continue to go higher from here. So thank you guys for watching this video on UnitedHealth Stock. Please subscribe. Only 12% of you guys are subscribed to the channel, so please hit the subscribe button, hit the like button, comment down below, give me some feedback, and give me some stocks to analyze next, and thank you guys for watching. See you.